This is a list of the greatest single trades of all time. Some of the best setups, the biggest profits, and how they were made. Most of these trades were easy for me to pick for this list, but my top 3 or 4 were actually really hard for me to rank. So if you have a guess before watching the video of what trades I'm going to include, or a ranking, let me know in the comments below. Before I go into the list, I need to set out the parameters for what exactly constitutes a great trade. How do you separate a great trade from pure luck? For example, I once had a friend put $600 in an out-of-the-money short-dated option trade and cash out the very next day for $65,000. Now that was obviously a fantastic result, but not a great trade. Even he admits it was nothing more than luck that happened to work out. A great trade includes a few things. First, there has to be a fundamental reason for the trade. There are many examples of traders profiting using primarily technical analysis, but the greatest trades in history all have fundamental logic at their heart. Second, the trade needs to have asymmetrical risk. Well, this is a critical concept that a lot of traders never seem to master. Asymmetrical risk towards the upside basically means that if the trade works, you stand to gain much more than you could lose. Third, the trade needs to be within your risk tolerances. No betting at all. I'm also only including trades that had really big sizes. I've met many investors who turns thousands into hundreds of thousands or hundreds of thousands into millions, but those trades just aren't big enough to make this list. Starting us off at number 10, David Einhorn betting against Lehman Brothers. In 1996, Einhorn started Greenlight Capital with less than $1 million. At its peak, he built it up to a $10 billion fund. His most famous trade started in 2007 when he initiated a short position in Lehman Brothers between $70 and $80 per share. He placed that trade due to his conviction that Lehman had much larger exposures to real estate than was actually being reported. In a speech that is now famous, he delivered at the Value Investing Congress in 2007, he made his thesis public. In April of 2008, he gave a speech titled Accounting Ingenuity at the Ira W. Sohn Investment Conference. Well, this speech is famous for the level of detail he provided in justifying his short position. He pointed out several accounting discrepancies in his speech, and it was full of details. For instance, he highlighted a table footnote that explained that a line item labeled Other Asset-Backed Securities was actually real estate CDOs, basically derivatives on real estate. He then went on to explain that in a meeting he had with the CFO of Lehman just a week earlier, the CFO couldn't adequately explain all the discrepancies he found. By September of 2008, Lehman had declared bankruptcy, and Einhorn walked away with a huge profit. At number 9, I put Jim Chanos and the Enron short. To understand why this was such a great trade, we have to keep in mind how the world viewed Enron in the year 2000. Between 1996 and 2001, Enron received the award for America's most innovative company by Fortune 6 times in a row. Well, now we know the most innovative thing about Enron was their creative approach to accounting. But at the time, analysts were almost universally bullish on Enron. As of October 18th, just over a month before Enron declared bankruptcy, all 15 analysts, tracked by Thomson Financial First Call, rated Enron a buy. 12 of them rated it a strong buy. In fact, RBC Capital Markets and UBS Warburg didn't downgrade Enron from a strong buy until the stock fell to just over $4 a share. And we know all of the problems now, but how did Chanos see this ahead of time? Well, in 2000, Chanos saw a troubling pattern of insider sales and executive departures at Enron. During his research, he also noticed that in their SEC filings, Enron had a lot of opaque footnotes about questionable off-balance sheet partnerships. Valuation levels were also extremely high, and Chanos began shorting the stock in November of 2000 when the stock was trading for $80. By the time he closed the position, he ended up making a profit of $500 million. The next trade on our list is one of my personal favorites because it involves global analysis, physical assets, and quite a bit of intestinal fortitude to pull off. Andy Hall was known as the oil god during his trading days. Now, he made several fortunes timing the oil markets, but arguably his greatest trade was in 1990. At the time, oil prices were depressed, and this was creating tension among OPEC members. Iraq specifically had been pressuring Kuwait to slow oil production, but Kuwait refused. Kuwait and Iraq also had a dispute over war loans that Kuwait had provided to Iraq. Andy Hall thought that Iraq invading Kuwait was a sure thing and began buying cheap oil and storing it in tankers to sell later at a higher price. As the probability of invasion increased, he removed his hedges, lowering his cost in the trade and increasing his profit potential. Between the invasion of Kuwait in August and October of that same year, oil prices nearly doubled and Hall made huge profits. By removing his hedge, the trade became incredibly risky, but because the fundamentals were in place, this trade gets to stay on my list. Trade number 7 goes to John Paulson. Now, this trade may be a bit controversial due to the structure of the trade and the subsequent fallout and penalties levied on the brokerage firm that enabled the trade. Like many other investors, Paulson recognized weaknesses in the subprime mortgage markets in 2006, and he searched for a way to bet against housing. He was able to start a fund with $147 million, and he raised and worked with Goldman Sachs to create a security known as the Abacus 2007-AC1. The Abacus 2007-AC1 was a synthetic collateralized debt obligation based on subprime residential mortgage-backed securities. This would then be marketed as a secure investment. Paulson would then short Abacus by entering credit default swaps on that product. In plain English, he was able to place a leveraged bet against housing through the creation of this derivative product. Well, the controversial part comes with Paulson. Paulson was involved in the mortgage selection process, and he even acted as an advisor to the counterparties in the trade, but never revealed that he was planning on shorting them. Goldman Sachs received a $15 million fee for their role as broker, and again, neither Goldman nor Paulson ever disclosed that Paulson was betting against Abacus, the very thing he helped create. In the end, this, combined with other trades, made Paulson's firm $15 billion in 2007, an 800% return. His fund made another $5 billion in 2008. Paulson's personal take, $6 billion total. The counterparties to the Abacus trade lost everything, and Goldman Sachs ended up paying a $550 million fine for its role, still one of the largest fines in SEC history. John Arnold takes the spot at number 6 on this list. Arnold got his start as an energy trader at Enron. Arnold was known for being very picky about what trades he would take and not being afraid to take a huge size when he traded. The majority of his gains every year would come in just 1 or 2 trades. Arnold considers himself a speculator who looks for pricing imbalances in markets. In 2001, he became known as the King of Natural Gas after earning $750 million for Enron and netting himself an $8 million bonus while doing so. The bonus became a symbol of excess to many detractors, but when Enron collapsed, Arnold was not actually accused of doing anything wrong. He then founded the hedge fund Centaurus. Centaurus had an amazing track record, but by far the best year was in 2006. In 2006, the rival hedge fund, Amaranth Advisors, placed a trade betting on an increase in natural gas prices. Amaranth's position was enormous. At its peak, Amaranth was 70% of the market. It was so big that it couldn't unwind its position without moving markets. Arnold happened to be on the other side of the trade, thinking that natural gas was not going to go up. When natural gas dropped, Amaranth collapsed under its own weight, and Centaurus profited over 300%. Arnold retired at the age of 38 a few years later and has pledged to give away most of his fortune, currently listed as more than $3 billion to charity before he dies, and he's already given away close to $1.5 billion. David Tepper gets the 5th spot on my countdown to the greatest single trade of all time. In 1993, Tepper started his hedge fund, Appaloosa Management. Early in 2009, Tepper realized that the government was buying preferred bank stocks, which would be converted into common shares at prices greater than the current values as part of the financial stability plan. Well, Tepper bought common stock, preferred stock, and junior subordinated debt in distressed institutions, including names like Bank of America, Citigroup, and AIG for pennies on the dollar when investors were afraid of the companies going bankrupt. When talking about AIG, Tepper later said, "About 1 week before everyone thought they were going bankrupt, we bought $100 million of their commercial paper for 30 cents on the dollar." In total, Appaloosa ended up buying about $1 billion worth of AIG securities at 9 cents on the dollar. Appaloosa made $7 billion on the trade, and his personal take that year was $4 billion. Now, this trade ranks really high on my list because it's very low risk relative to the potential return, especially when recognizing that the government was not going to let any other major banks go under, which was the primary fundamental driver in this trade. These next 4 trades were really hard for me to decide between. I'd be happy to listen to any arguments you guys might have that might reorder the rankings here. But at number 4, I'm putting my personal favorite trade in this video. This was Sir John Templeton shorting the dot-com bubble. Templeton made his first fortune by purchasing 100 shares of every stock on the New York Stock Exchange that was trading for less than $1 per share in 1939. He did this on the day World War II began. When industry picked up due to wartime mobilization, he made many times his money back. He became known for being able to recognize value stocks and buy them cheap. He was also known for his ability to take profit near market peaks. Traditionally, Templeton was a bullish value investor, but I think his greatest trade was when he started shorting tech stocks in January of 2000, right before the dot-com bubble burst. His plan was simple but brilliant. Focusing on stocks that were trading for 3 times or more than their IPO price, he established short positions 11 days before their IPO lockup expired. His logic was that company insiders would sell stock as soon as they could to lock in profits, and that would be the catalyst that would cause these stocks to begin falling. He took profit when stocks dropped 95%. Or when valuations came within what he deemed to be reasonable levels, and he also cut his losers short to control his risk. Overall, he made about $90 million shorting the dot-com bubble, and later called the trade a once-in-a-lifetime opportunity. Even though this is my personal favorite trade on the list, I can't put it higher, because while $90 million sounds like a lot of money, compared to the other trades on this list, it's the smallest. The number 3 spot is going to Paul Tudor Jones, who made a fortune on the biggest one-day crash in modern stock market history. On October 19, 1987, the Dow Jones Industrial Average dropped over 22% in a single day. Today, it's remembered as Black Monday. Tudor Jones recognized that the market was overvalued and likely headed for an adjustment. The Dow Jones Industrial Average had been basically going straight up for 3 years and was up 69% year to date in 1987. Jones wasn't alone in thinking this. Many traders recognized the market was expensive and expectations of a pullback were actually pretty common. The key to Jones's trade, and what makes it great, is that he recognized that there were no downside limits on financial futures. For decades, commodity futures had limits on them to prevent panic buying or panic selling. So for example, if cotton rose too high, trading would not be allowed at any higher prices for the rest of the trading session. The same thing happened if markets dropped too quickly. They could hit limit down and thus prevent a panic. Financial futures did not have these limits, and Jones recognized that without limits, when the market started to sell off, it could cause a chain reaction of selling. This created an asymmetrical risk opportunity that he could take advantage of. Going into the day on October 19th, Jones was short the financial futures, and by the time the dust had settled, he had profited over $100 million. His fund returned 125.9% after fees. Number 2 on my list is Michael Burry and The Big Short. Burry's largest success came during the financial crisis of 2007 and 8. He was made famous by the Michael Lewis book, The Big Short, and the subsequent Hollywood blockbuster film based on the book. But his success was not just a flash in the pan or mere luck. Through his fund, Scion Capital, Michael bet against tech stocks heavily in 2001 and 2002, making 55% and 28.69% respectively. He made another 50% in 2003 when the market started rising and he went bullish. By mid-2005, his fund was up 242% at a time when the overall market had moved up less than 7%. Burry defines himself as first and foremost a value investor. He looks for assets that are either over or undervalued and invests accordingly. In 2004, Burry discovered weaknesses in mortgage bonds. He discovered these weaknesses primarily by doing what nobody else did. He read the prospectus. Now keep in mind that each mortgage bond prospectus was about 130 pages long, full of all kinds of legal jargon, and he read hundreds of these. Now, reading these, he deduced that there was a high probability that mortgage bonds would soon begin suffering defaults in huge numbers. In 2005, he was able to talk Deutsche Bank into selling him his first credit default swaps. He soon made deals through the Bank of America and Goldman Sachs, among others, and had $750 million worth of contracts. His problem was he was a little early to the game. In 2006, many of his investors began demanding their money back as Scion lost 18% due to the enormous insurance premiums he was paying.
Give it back! Give me back the money!
Burry was able to hold on, and by the time he liquidated his position in June of 2008, he had made $700 million in profit for his investors, net of expenses and fees, along with $100 million for himself. This more than doubled his fund on one trade. The brilliance of this trade is that it was actually a pretty simple trade. Burry did his research by actually reading what I can only imagine were mind-numbingly boring and repetitive prospectuses and discovered an extreme value mismatch. He also structured his trade in a manner that provided huge potential returns relative to the risk he was taking. Before revealing my top pick, I want to list a few honorable mentions that didn't quite make the list. Jesse Livermore, the man who inspired the book Reminiscences of a Stock Operator, shorted stocks in 1929 before the stock market crash. He made about $100 million doing it, which would be the equivalent of about $1.7 billion today. Well, this trade didn't make the list for two reasons. It's not documented extremely well, and he bet it all to do it. The next honorable mention goes to Thales of Miletus. He placed the first known option trade back in about 600 BC when he leveraged contracts on olive presses to obtain a harvest time monopoly. Bill Ackman also gets an honorable mention for his hedging in 2020. Ackman was actually bullish overall, but recognized the potential seriousness of COVID-19 and so spent about $27 million on a hedge that would gain if markets fell. When markets fell, the hedge was worth about $2.6 billion. He then sold the hedge and used that money to build up his overall bullish position and made even more money. While brilliant, this trade didn't quite make the list because it was more of an extremely successful hedge than it was a directional trade. Andrew Krieger, who goes by Andy, is one of the greatest currency traders ever and also gets an honorable mention. Now, he first made $300 million betting against the New Zealand dollar in 1987. Unfortunately for Andy, his trade gets overshadowed by another 1987 trade that already made this list, but he definitely deserves mentioning. The last honorable mention goes to the mysterious trader known as 50 Cent, not to be confused with the rapper. At the time, the trader was unknown, but now we know it was the Rougher Total Return Fund. This fund made $200 million on a volatility hedge in 2018 and another $800 million in a similar trade in 2020. The fund earned the nickname 50 Cent because of its tendency to buy out-of-the-money call options on the VIX for 50 cents each. Now, this one being a hedge as opposed to a directional trade is what keeps it off this list. It's time to reveal the number one trade of all time. And you may have guessed it already. It's George Soros versus the Bank of England. In 1990, Great Britain joined the European Exchange Rate Mechanism, or ERM, which was part of the European monetary system designed to foster monetary policy cooperation among European countries. The ERM was supposed to be able to prevent currency exchange rates from fluctuating by more than 6%, and this was theoretically possible through coordinated interest rate adjustments as well as governmental buying and selling of currency. Stanley Druckenmiller, who worked for George Soros' Quantum Fund at the time, observed that the UK had joined the ERM at an unfavorable level, and that it was highly likely that the British pound would drop dramatically. When Druckenmiller presented the idea to Soros, Soros recognized it as an opportunity to go big. Because if the pound did not fall, he would not lose much money. But if it did fall, he could make a huge amount of money. In other words, a perfect asymmetric trade. Over a period of several months, Soros built up a short position worth billions of dollars, and other traders followed suit. The British government tried to defend the pound through purchases, but eventually had to wave the white flag of surrender and let markets have their way. By the end of the day, on September 16, 1992, a day now known as Black Wednesday, the pound had collapsed, and the Quantum Fund had profited $1 billion. George Soros is now known as the man who broke the Bank of England, and the trade was called the Trade of the Century. So there you have it, my list of the 10 greatest trades in history. What do you guys think? Did I leave any out or did I get the order wrong? Let me know in the comments.